Hello, everyone, and thank you for joining us for today's webinar, Opportunities in Emerging Market Technology. We have two very great panelists for you today. First panelist is Kevin Carter, who is founder of EMQQ. EMQQ is an ETF tracking e-commerce and internet companies in emerging markets. And before that, he was also CEO and founder of Alpha Shares, an investment firm which, among other things, offers the well-known CQQQ index. Both EMQQ and CQQQ are ETFs that you can find, among other emerging market ETFs, of course, also on our platform. But I'm sure Kevin will touch later upon that more. And then we also have Vivek Mohindra with us, who is the co-founder and responsible officer at Crystal.ai. So he will touch more generally upon emerging markets. Thank you, both of you, for being here. So very quickly about today's webinar, please, for those very experienced gentlemen, please use the time well and ask all potential questions you might have. You can use the Q&A tool for that. If you have any other questions left, please use the please send your email to support@crystal.ai. And finally, this webinar is being recorded. So in case you want to share it or review it after the session, we will send out the link after we finalize the video. You will find all the webinar recordings we've done so far on our YouTube channel. Just head over to crystal.ai and look in the playlists for our Crystal Online playlist. And finally, we want to get to know you, our audience, a bit better. And for that reason, we already sent out a survey yesterday to our clients. We received over 300 responses, asking people about which market they think will basically outperform, or which market they have most faith in this hard time. So on the screen, you can right now see the results. So over 43 voted for outperformance of the US. But a runner-up with a very great 30% is China, and which is a great response in the light of this webinar, as I'm sure Kevin and also Vivek will touch upon later in their own talks. So to also get to know you a bit even better, we have one very quick poll which I'm launching right now, which you should be able to see on your screen. So if you could just take 1 second to help us understand which financial products do you prefer. Are you interested in individual stocks, mutual funds, ETFs, bonds, commodities, and so on? So just take 1 second and answer the screen, and after that I will hand right over to Vivek to start the session. All right, looks good. Thank you so much for your responses. Looks like we have very big interest in ETFs, but also single name stocks, which is definitely interesting for our speakers today. So I'll hand over to Vivek now. Please.
Yeah, actually, thanks a lot for that, Barbara. Yeah, it's a very interesting poll, and it's kind of ties in a little bit with my personal experience, because kind of all of us start our investment journey with stocks, and that's what I did myself. So you start with stocks, and then you invest in stocks that you like, that well, like the products that you use could be Apple, could be Google, and then after some time you kind of graduate to using funds, because it makes certain markets accessible to you, which you may not otherwise be able to access. And also, of course, there's diversification of risk. And in the same journey, then you finally move to ETFs. And that's been while they were introduced a long time back, but that's really matured as an important segment to invest in over the last few years. The costs have come down significantly. Liquidity has increased a lot. There's also usage that have come in, which are very tax advantageous for people from Hong Kong and Singapore, because there's no withholding tax. But the fact remains that the biggest market continues to be the US ETF market in terms of liquidity. There's been a huge democratization in terms of the ETF market, because it's not only individual small retail investors who are investing in this, but also the Federal Reserve. As you know, the Federal Reserve is one of the biggest holders of bond ETFs now. So when you participate in the ETF market, it's you're participating with high net worth individuals, institutions, as well as central banks. Japan has always been buying ETFs, and now the Federal Reserve has bought ETFs. So you kind of it gives you a little bit of comfort, as in that you're participating along with the institutional investors, and there's a lot of trust security there and liquidity. It's obviously very easy for settlement purposes, and which is why we kind of advise people to move in terms of, if you want to do trading for fun, for thrills, please go for stocks and buy and sell what you like. But if you really want to do go on your investment saving journey, long-term asset allocation, get away from the emotion and the behavioral biases of investing. I have a couple of videos on these topics, which are also there on the Crystal YouTube. But if you want to get away from those biases and do actual safe long-term investing, then ETF is the thing. Most of the investing in ETF is done in broad market indices, which is S&P, you could MCHI, which is MCX China, MCX India, and so on and so forth. But over the last few years, we have had a lot of sector-specific ETFs, and which is why we are talking with Kevin today. That enable you to take more niche exposures in certain markets that may be that may look attractive. It may be beneficial for you. It could be cloud computing, commerce, internet, and so on and so forth. So these sector-specific ones are geography-specific in some cases. So it could be US, China, India, so on and so forth. But also it could be industry-specific. And Kevin kind of brings together both of them in the same thing. So he focuses on the technology sector, and he focuses on emerging markets. So that's kind of a good bet to take place. And the reason why we got him there is because we do feel that it's quite attractive. Just before he starts, I'm going to start, I'm going to show one thing on our, let me just see if I can do that. Show his ETF on our platform. So this is our platform. So if you want to look at it, just go there. You don't need to log in. You can just go into our Crystal page. There are some products. And then you can see a bunch of ETFs there, and then let's say you want to look at technology ones, which is what we're going to talk about today, and then let's say you look for EMQQ. There you go. That's his personal ETF. And then you have all this data about EMQQ. What does it do? And you can see the returns. The EMQQ chart has been outperforming. So you can kind of look at it 1 year. So this makes it easy. Of course, you can go to the EMQQ website and they will have this information. But we also have this stuff here. Performance 1 year 47%, 3 year, all the facts there. Projected returns is quite interesting. If you invest $1,000 a month for like 1 year, what will you have at the end in 3 years, 5 years, just to give you an idea. Asset classes, what it holds, his old holdings, and of course, Kevin will speak a little bit further about this, but this is just a fact sheet, sector breakdown, and so on and so forth. And you can kind of compare it with other ones. I've just got this little comparison thing here, the other technology ETFs, and then you can kind of compare it here. We'll look at this a little bit more in detail, but if you want to fool around with it while Kevin is talking and look at it, in terms of what information there is available on his EMQQ, please feel free to do that. Over to you, Kevin. I'm going to stop the stream.
Great, and thank you for having me here. So I'm going to tell you a little bit about me, but a super short amount, just to give you my perspective on the world. I'm going to tell you what I think the most important thing is to know about emerging markets. I'm going to explain to you how EMQQ came to be and what it is, and I will hope to convince you that it is, for long-term investors, the best way to get exposure to emerging markets. So just as quick bio, I am located 15 miles east of San Francisco. I have lived here my whole life except for a few years off at college. And I started my investment career 28 years ago here in San Francisco. And as I tell people, first and foremost, I am a Warren Buffett, Charlie Munger, stock picking, so-called value investor. And I pray towards Omaha first and foremost. But for the last 20 years, I have worked with the author of this book, A Random Walk Down Wall Street, which I was told to read after my one and only interview after college. And they told me I could start Monday. And I said, I don't know anything. And they said, go and read this book. And without going into the details, one thing led to another, and I've been working in partnership with the guy that wrote this book for the last 20 years. If you've read this book or know anything about this gentleman, he's a Princeton economist. He's on the board of Vanguard, and he's one of the founding fathers of indexing and was the chairman of the committee that created the first ETF. And so he and I have been together working for a little over 20 years. 15 years ago, he had taken an interest in China, and it was right about the time Google had gone public, and I had become sort of the default investment advisor to a bunch of early Google engineers. And they heard about Burton's interest in China, and they said, can Burton give a China talk down here in Mountain View? And so 15 years ago, Burton and I drove down to Google, and he gave a talk about investing in China. And as soon as he was done, all of these Google guys looked at me and said, we want to invest in China. And I didn't even know what that meant at the time. And now I will attempt to summarize for you the most important thing you should know about investing in China and more broadly in emerging markets. So as general background, emerging markets, of which China is the largest, they are the world. They're 85% of the world's people. They're even more of the future as measured by people under the age of 30, where they account for almost 90% of the world. And as this slide shows on the left, emerging markets are now bigger than developed markets on a GDP basis. But if you look on the right side, you'll see 3 red arrows showing you the emerging economies' share of, at the top, population again, most of the world's people. But that down below, 2 more red arrows pointing out that in the consumption categories, emerging markets are way behind. And it's the delta between that top red arrow and the bottom 2 red arrows. That's all you need to know. That's the story. The thing that's emerging are the people. There's billions of people moving on up, and they want stuff. They want more and better food, more and better clothing. They want appliances, entertainment, vacations, cars, and they want their kids to go to Harvard. And that's the most important thing to know. And it is what McKinsey and Company calls the biggest growth opportunity in the history of capitalism. And even if they're wrong and it's the second or third biggest growth opportunity in the history of capitalism, it's still a big deal. And that is what EMQQ is all about. And really what EMQQ is, if you think about it, is a confluence or a mashup of 3 different mega trends at once. The first one, again, the emerging market consumer. The second one is called the computer. Now, I've had a computer for 30 years. First it took up my desk, now it's in my pocket. It's still a pretty new thing, the smartphone. And it was 6 years ago that a friend of mine called me and said, what's the best emerging markets ETF to buy? And here in the United States, there is an ETF called the Econ, the Emerging Market Consumer ETF. And that's what I always told people to buy. But 6 years ago, I got a phone call from a friend, and she said, what's the best emerging markets ETF for my daughter's college fund? And I started to tell her to buy the Emerging Market Consumer ETF. But I had a light bulb moment when I realized, wait a minute, consumption is changing. Back then, my family had been going to this store 4 or 5 times a week, which was easy to do. It's 3 miles from my house. We have a car, the roads are paved, and there's free parking. But I noticed that all of a sudden, this guy started to show up at my house once a week, and then twice a week. Now, pre the coronavirus, my family had basically stopped going to this store except maybe once a month. And this guy and others like him are at my house 20 times a week. And so if you think about how the smartphone has changed the developing world, where consumption was pretty easy before, and you map it over to the emerging markets, the story gets pretty big. So colliding with that rise of the emerging market consumer is the computer. But most of the world's never going to have a computer like the one I'm looking at. Most of the world is getting their first ever computer. It's not on their desk, and it never will be. And for the most part, it doesn't have an Apple logo on it, because what we're talking about are $60, $80, $100 Android-based smartphones made in China by Xiaomi, Vivo, Oppo, Huawei. So that's the second part of the story, the computer, which we take for granted in the developed world, but most of the world is just now getting. And what it comes with is the third part of the story, which is called the internet. I've had the internet for 25 years here in San Francisco, first over telephone lines, then via cable, broadband cable, and then they gave me a box to put by the cable box so I could sit on my couch with my foldable computer. Most of the world's never been wired. And so when these billions of consumers get their first ever computer in form of a smartphone, it's also bringing with it the internet. And as you can see here on this slide, the green bars are the emerging markets, and you can see the smartphone penetration rate. You can see in India, it's only 25% over to the right there, which means there's still 1 billion people in India and a couple billion people collectively in the developing world that don't have a computer or the internet yet, for the most part. Because if you're in Western China or India or Brazil or Africa, and if you don't have a smartphone, there's a 100% chance that you also don't have a MacBook Pro at home on your desk. So that is the third part of the story. And the result is this. This is the so-called money slide, literally and figuratively. What you're seeing here is the 10-year revenue growth of the emerging markets internet sector ending at the end of 2019. That's what the blue bar shows you. You can see in gold to the left, that's an average annual growth rate of revenue of 38% for a decade. Now, when I launched this fund back in 2014, all I had was the left side of the slide. And I gave my first presentation to the CFA Society of San Francisco, and I offered a ham sandwich to anybody that could show me a sector that's ever grown this fast. After giving another couple dozen CFA presentations and another couple years of growth, I raised my reward to $10,000. Now, when I give CFA presentations, I offer $100,000 to anybody that can show me a sector of publicly traded companies that have ever done this. I mean, that is hard to do, to grow at 38%. I've asked everybody I know. I've asked my business partner who's been teaching in the Ivy League for 50 years. And at this point, I'm 99.5% sure this is not just the fastest growing sector in the world today, but the fastest growing sector in the world ever. And so that is the result of this great confluence of those three mega trends. And for investors, while the broad emerging markets approaches have gone nowhere, as you can see in yellow here, that's the iShares MSCI index-based emerging markets ETF. It's been a lost decade. Yet in the internet space in blue, investors have actually done quite well. And to be honest, I'm not so optimistic that the emerging markets broad indexes are going to somehow have a great next 10 years, because the indexes don't really capture the growth. The indexes are laden with state-owned enterprises, which are really not for-profit operations, and Petrobras in Brazil, the poster child for this. So I think that broad emerging market indexes are the ultimate value trap. People look at the PE multiple and they say it's 10 or 11 times earnings. But if you knew, as a lot of you probably do better than Americans, but if you knew what the Agricultural Bank of China was, or you know about the two presidents of Brazil that are in jail for stealing your money, you probably would think 11 or 12 times earnings is actually expensive for that group of companies. So that's it. Fundamental growth, value creation. Everybody knows Alibaba. This is our biggest company and the most well-known of these companies. Trades here in the United States. And let me point something out about that. Most of these companies trade on US exchanges. And the reason is that most of them, while they're funded by local entrepreneurs, they're founded by local entrepreneurs, they're funded by US institutional investors, whether that's Harvard or Stanford's endowment, or in these two examples, US corporate investors. You had Jack Ma get $1 billion investment from Yahoo, which turned into 50 for Yahoo. Or in my favorite story from 2019, this Brazilian fintech company Stone went public on the NASDAQ, and my heroes in Omaha actually bought 8% of the deal. And the reason I'm pointing this out to you is that emerging markets, the corporate governance is your biggest problem. The Petrobras of the world are your problem. These companies list on US exchanges historically because we've had the highest listing standards and the most transparency, and that is good for investors because corporate governance is actually really. You obviously know Alibaba, you know Tencent. Americans are starting to know Tencent more and more. To make it simple for them, we tell them it's the Facebook of China, and that's obviously true. But in the case of Alibaba and Tencent, there's so much more and don't really have US equivalents. And the place where this is showing up the most right now is in financial services. As you all know, there, everywhere in China, you can buy anything with your phone. And you'll find the 2 QR codes that are here on the table to the left of the bananas, wrapped in green and blue. And this is a big deal. And the fintech part of the EMQQ story is the most powerful sub-trend right now, as the developing world, the emerging markets, leapfrog what we think of as traditional consumption and do everything on their phone, including banking and the money. And Alibaba and Tencent have the money now. And it's sort of a paradox. You would think me, a fintech entrepreneur in the San Francisco Bay Area, that I would be the guy that walks around with my phone and buys everything like George Jetson. And yet it's places like Kenya that are amongst the most advanced in terms of mobile payments. Now, you know the Chinese names. Let's talk about some of the other ones. Mercado Libre. This is the leader in e-commerce and payments in all of South America. Technically, it's an Argentinian company, but the biggest market for it is Brazil. And it's both the leader in fintech and commerce. And as a contrast in terms of corporate governance, founded by a Stanford grad student while he was at Stanford. Michael Spence, a Nobel Prize-winning Stanford economist on the board early on. eBay, an early strategic investor. So you ask yourself, how do I want to invest in Brazil? Do I want to invest in the state-owned oil company that sent 2 presidents to prison? Or do I want to buy this entrepreneurial internet company, Mercado Libre, which importantly, Mercado Libre is not even in the broad index. So if you own an iShares or Vanguard Emerging Markets Fund, you own Petrobras twice, but you don't own Mercado Libre at all. And I think, while I'm biased, I know what I want to own. Eastern Europe has Yandex, historically the Google of Russia. It's also now the Uber of Russia. Yandex Taxi is the dominant ride-hailing app in Eastern Europe. Uber competed with Yandex, but forfeited and departed Russia, but not before it swapped its business for some equity in Yandex Taxi, which would have likely IPO'd this year had it not been for the coronavirus. India's got the most opportunity right now. Unfortunately, there's only a few public companies, Indian internet companies. This is one example, but there's a lot of unicorns, a lot coming down the pipe. Some of you have probably followed this Reliance Jio flurry of fundraising that it sounds like Google's going to I mean, the list keeps growing of what's happening with Reliance Jio. So maybe that'll come public and give us some more exposure. But India represented. And finally, Africa. This is Jumia. This is a Nigerian internet company that went public on the New York Stock Exchange last year and was added to EMQQ. Operates not just in Nigeria, but also in a number of other sub-Saharan African companies, or countries rather. And then I just want to point out one other thing that some of you likely know, but within the 83 companies that are in EMQQ, there's an equity exposure to hundreds of private companies, not because we go out and buy them, but because Alibaba and Tencent are two of the top 5 largest venture investors in the world today, and have hundreds of investments, including in Didi, which you all know. Most Americans have never heard of it, but Didi, the Uber of China, is partially owned by both Alibaba and Tencent, and also by Tim Cook and Apple. And so that's one example of a private company you get indirect exposure to by owning Alibaba or Tencent. And the other one that I like to feature is the Indian fintech company Paytm, which is almost 45% owned by Alibaba. So by owning Alibaba, you get a pretty healthy piece of this company, and I feature it because my favorite story from 2018, Berkshire Hathaway, also an investor in Paytm. So in terms of summarizing what I've attempted to tell you, this is a growth story. This is a combination of these 3 mega trends happening at the same time. 85% of the world's people becoming consumers, becoming digitalized with their first ever computer, and getting online with their first ever internet access. And because of a lack of traditional consumption infrastructure, because of a lack of bank accounts and debit cards, because of there's no TVs on the wall with 1,000 channels, there's no Target stores. It's providing this leapfrogging effect, which explains the incredible growth rate. Important side benefits: in a part of the world where lots of people are trying to steal your money, you get really good corporate governance. And finally, you get exposure to a lot of private companies and frontier markets. So that's the story. And in terms of, and I want to be mindful of time, but in terms of where we are right now, I'm very worried about this virus. You know, I'm on 3 acres with 5 people, but that's not hard for me to socially distance. But in lots of the world right now, people are facing this, and social distancing is not a possibility. You've got areas of the world where 5 people are sharing 200 square feet, and on the other side of the wall are 5 more, and the sanitation and so forth is not conducive with social distancing. So I'm concerned. China's got a lot of advantages to keep the outbreaks from flaring up too big right now. I think that in addition to just a cultural and authoritarian sort of advantage, they've also, I think, got better technology to basically minimize the extent of further outbreaks. The Chinese economy looks to be recovering faster than any other major economy will. Not back to 100%, but at least Apple and Starbucks and Tesla are telling us that business is moving again. And finally, and I'm always uncomfortable in talking about this right now, but what happens when the coronavirus comes to town? You lock yourself inside and do everything on your phone that you used to do, but you do it more. So a lot of these businesses have had a surge in usage. That doesn't necessarily, and it actually does not translate into a surge in revenue, but that's benefiting EMQQ. And then there's all, whole other elements of the EMQQ story that are getting forced into adoption, whether it's distance learning or telemedicine or food delivery. So all of those things combined have actually put EMQQ in a pretty good position this year. and we've had pretty good returns. So that's the story, and I'll turn it back to Vivek now, and if you have any questions, we can go into those.
Yeah, no, thanks a lot, Kevin. That's really useful. And I was just taking off from your one specific point that the broad market indices don't really cover. So I want to make it more specific to, let's say, the Nifty, Indian Nifty, or the Hang Seng in Hong Kong, which barely has exposure to these internet companies. And therefore, if you're looking at, it's basically been a decade of lost growth for even the Hang Seng, where it hasn't really appreciated much. But all the growth has come from the, kind of equivalent, the Chinese internet companies, I call them the ATMs, the, Alibaba, Tencent, Meituan, which have, outperformed significantly. So one of the questions is, of course, so when we invest, there's the broad market index, but yours is also kind of a passive strategy. So I just wanted you to explain how the allocation is done, and that how you feel between active versus passive in terms of how a person should allocate his overall portfolio.
Well, look, as I said, I pray towards Omaha, so I believe in stock picking. The biggest problem with hiring an active manager is that they're diversified their way out of the ability to add any alpha. I mean, once you own 50 stocks, you own the stock market. And the mathematics of this is quite simple. If you're going to pay an active guy 1.5%, and somebody will give you the whole market for free, the average active guy is going to underperform by 1.5%. Not everybody can, the average has to be average. And so I think that if you're going to go diversified, you ought to go with an ETF. I do both. I mean, I own EMQQ, but I also own some of the individual stocks. So EMQQ is really an active bet, but it's an index-based passive approach. So the approach that we use in EMQQ is very simple. We have a rules-based index, and by far the most important rule is that you have to be an emerging markets internet company, as measured by not where your stock market is and not where you're domiciled, but by your income statement. Where does the cash register get filled up? And I'll tell you that when you get into emerging markets, I've seen a lot of things that make me skeptical about the databases. And I mentioned earlier that I used to tell people to buy the emerging market consumer ETF, which again tracks the Dow Jones Emerging Market Consumer Index. And I always remember that I went through every stock in that, and the largest stock at one point was called Steinhoff International, which was a South African furniture company. At least that's what the database called it. But when you looked at the business, it traded in South Africa. It was headquartered in South Africa, but all the furniture was sold in France and Germany. So you're getting this emerging market consumer story, and you're like, yes, I want all these consumers in India and in China and where people are moving on up. And the database says this is a South African furniture company, but all the revenue was in France and Germany. So we don't care where you trade or where you're domiciled. What we care about is what your financial statements say. And if you are an emerging markets internet company, as long as you meet our minimum size and liquidity, we include you. And then we rebalance and reconstitute the index twice a year in June and December. And it's market cap weighted with one modification, which is that we limit the largest holding to 8%. So when we do our rebalance, at least for the foreseeable future, you'll find Alibaba and Tencent in the 1 and 2 positions. I think Tencent just passed Alibaba in the last week after lagging Alibaba for a bit. But those two stocks, because they would be close to 40% of the fund, we cap them at 8 and push everything else down below that.
So one more question also. Let me also share one interesting graph, which I kind of. So if you look at the the performance of let me see, of the internet companies, basically, I just looked at like the FANG, which is everybody talks about, and how the China internet companies have performed over the last couple of years. And actually, the outperformance is quite significant, and that is obviously quite captured in your portfolio fund also. So that's so I'm glad that you're looking at and this focus industry. But one of the questions which is coming up again and again is if you could just touch upon it briefly, is the US-China, whether the trade war, how is it going to impact some of these companies, and also the move in listing from US. So for example, now we've seen Meituan, JD, NetEase, all of them have a second listing in the Hong Kong stock markets. And is it better to pick the US market or the Hong Kong market to have the exposure?
Well, we don't care what market these companies trade on. We own stocks in Hong Kong. We own stocks here. And that doesn't bother us. In terms of the trade war more broadly, this is one of the things that's very troubling to me. And I'll tell you that, 13 or 14 years ago, after a year or two focused on China, I thought to myself, you know what? Americans are misinformed about China. We have this very negative view that's propagated by our media. I mean, every adjective and adverb is decidedly negative when China's involved. And I just remember thinking, we're going to warm up to China. These are great people. They have a beautiful culture that's been around for thousands of years. And they have family values way more than the US does, which used to be a big thing here to talk about. And I think that sadly, I was wrong. China has been increasingly demonized here. And that was going on before the coronavirus. And now with the coronavirus and, the fact or the believed fact that it originated in China and that's become a political issue. I'm actually surprised it hasn't gotten worse yet, but there's a lot of tension and I'm troubled by it. I think it's troubling to me that my country has this sort of supremacy feeling that if we're not number one or if we're in any way threatened, that the other party must be bad. And so I'm troubled by the whole thing. In terms of the delisting, I've had to spend a lot of time looking at this. And the reality is, without going too deep into the details of it, that the Chinese companies are in violation of a rule we have, and the rule is that there's a government accounting agency, the PCAOB, that's supposed to be able to review the audits of these companies. When we passed the bill and said that these companies were not following the rules, I was a little confused. But what I basically realized was that some of these companies, the state-owned enterprises like Sinopec, were public before the PCAOB was even put into place. And I think what happened was the U.S. exchanges lobbied to not have that enforced, the ability to review the audits. And as of now, the Chinese law does not allow review of the audits. And so these companies are not in compliance. But this is driven totally by political reasons. And as you pointed out, these companies can easily list in Hong Kong or in other markets, London, for example. So it's a non-event for us, other than the fact that if the House of Representatives votes to pass it as the Senate did, I'm going to get 100 phone calls and people are going to be scared that their Alibaba investment's going to get stolen from them or otherwise turn worthless, which will not happen. But so there may be more noise about it, but I'm not worried, and we don't care which exchange you're on.
Thanks for that. I'm going to launch another poll because the new economy sectors are not just e-commerce and technology, and you can kind of see it. There's some other stuff happening. We get interest from our clients into various things like cloud computing, water resources, and there are sector ETFs for each one of these. Healthcare has obviously become a very top of the mind, and there was some positive news coming out in the morning, which has led to some risk on. So I just wanted to understand fintech. Yeah, So some of them are covered in EMQQ, some are not. So good to have this feedback. Also, Barbara, if you can look at any other questions and see you want before we wrap up. We're at
Sure.
40 minutes.
So we have one question about the FX risk. Emerging markets see massive devaluations from time to time, China being an exception. So how does EMQQ deal with that Forex risk?
We don't do anything to hedge the risk of the currency. Again, the majority of our companies trade in US dollars, but their businesses are done in their local currencies, and we do not hedge the currency risk, which I don't really follow currencies too closely, but I think that in at least the recent period that's actually been an advantage to some of the foreign currencies, but we don't do anything for that.
Another question we've got. So you've mentioned a couple of the holdings that are in EMQQ, but can you quickly touch upon which are the top holdings? And I saw that there's also an overweight in China, like the top couple of holdings are all in China, but so which geographies in general does EMQQ also include?
So China is the biggest part of the story, and again, we own every publicly traded internet company in the emerging markets, and so the result of that is that China has the biggest economy in the emerging markets, the biggest population, the biggest internet population in the world, and so that's about 2/3 of EMQQ. But there's all sorts of Brazil, there's Korea, there's Africa, there's Eastern Europe, but importantly as well, if you're looking at the databases, they don't always capture the economic reality. So Mercado Libre, the South American leader, is technically in Argentina, which is not a particularly large economy. It used to be, but it's gone backwards for 100 years. And so the fact sheet will say when Mercado Libre was our top performing stock last year, you looked at the fact sheet, it said we had 10% in Argentina. Well, the reality is that was largely Brazil, but it wasn't just Brazil, it was Ecuador and Costa Rica and every other Latin country that was part of the revenue mix, but the fact sheet would say Argentina. And so the fact sheet, the database is approximately right, but not 100% right. But China is the biggest piece.
So one last question, sorry, Vivek, before I hand over to you, because this is interesting, because we also have a lot of clients from India. And so I would love to know what is your view on India as a market to invest in long term. So first question to Kevin, but also to Vivek, because this question was actually asked to you.
I'll go first, Vivek, and then you can follow up. But the numbers are big. You've got 1 billion and more than 1 billion people, and still about 1 billion that don't have a smartphone, and some of the stories about how the smartphone changes the lives of these people when they get their first smartphone. It's inspiring, but they're coming off of a base that's very low, and I think that a lot of U.S. investors have sort of touted over the last 10 years, well, India is the largest democracy in the world, and that's got to be a good thing in terms of growth. And I think the reality is that India also has a lot of bureaucracy. And whereas China and India were, I think, a lot closer 10 years ago, I think China's pulled away significantly, and I think it's because their form of government, whether you like it or don't, is pretty effective in getting stuff done. And so I'm very bullish on India in terms of the EMQQ story, but I still think that the reality is that China will be a much bigger part of it fundamentally for a long time.
Yeah. From my perspective, I mean, I don't see any, like Kevin mentioned, I don't see any internet and these growth companies actually listed. So that's the biggest problem. I'm not going to invest in the Indian banking sector right now. So if I look at the index, I don't really want to invest in any of the other companies. The ones I want to invest in, which is why this Reliance Jio has got so much investment, because it's perceived effectively by the foreigners as an internet technology company. So it's raised 20 billion. Google is putting in another 4 billion, I heard today, and almost every big investor has put in, because this will be the biggest technology company, probably the equivalent of Tencent for India. It will be like Tencent. It will capture various segments. It's already launched something for competition to Zoom. There's a competition to TikTok, which has come into India, which got 100 million subscribers in 3 days once TikTok was banned. So India will probably protect its market like China does in terms of some of the apps, etc. And the growth story will be local, but you can't really invest in them, which is why you end up investing just in Reliance, or I hope Jio will get listed one day. So my trip is the only company, and then probably InfoEdge, which is locally listed, and there's no other company in this sector. That's the problem. But thank you very much. So I'm going to just sharing our page on our website. If people have any questions, there's this comparison tool you can kind of look at. Let me just see if this works properly. Yeah, I'm looking at EMQQ versus QQQ versus CQQQ. The sizes, risks, performance. As you can see, the EMQQ has kind of over a long period. Let's look at 1 year. These are the prices. I'm sorry, this is not the returns. But if you look at the performance, which is here, this is EMQQ has outperformed on the 1 year basis, but not on the 3 year basis, and pretty similar on the 5 year basis. Projected returns, holdings, you can compare different ETFs. So I'm just looking at technology today, but size, this is also like almost, hopefully, Kevin, best of luck to hit 1 billion soon. It's got a 5-star rating from Morningstar, etc., etc. And like I said, you can look at other sectors, look at compared performances. Let me just go back. There's technology, consumer, healthcare was obviously a segment which people were interested in, so this is kind of, and our relationship managers can help take you through some of this also. That's it from my side, Barbara. I think we kind of end in terms of the time for the webinar also. Thank you.
Yes. I think we can wrap it up here. Thank you so much, Kevin, for being here. It was really, really interesting, and I'm sure that our clients see it the same way. So
yeah, Kevin, thanks. Yeah, Kevin, thanks a lot. I mean, I know it's like the timing you didn't work out, and we scheduled it around to try and get it suitable for our clients and for you too. But I really appreciate you joining us and all the insight you provided. Thank you very much.
Okay, well, I appreciate you having me, and thanks to all of you. Have a wonderful day, and stay well.
You too.
Bye-bye.
Thank you, and thank you also to all of our attendees. As said before, we will send out the recording of this webinar as soon as it's ready. So have a great day, and thank you. Bye-bye.